Hello, everyone. Welcome to our webinar today, focused on where are hotel asset values today. We will get started momentarily as everyone is logging in. Welcome on behalf of Sales Boost and the panel we have. We're back and we're going to have a lively discussion. We will get started shortly. Thank you so much. As you are dialing in, feel free to use the chat feature and let us know where you're dialing in from. We always appreciate and like to see where our audience is currently hailing from. So use your chat feature to let us know. We also will be watching our Q&A. You can certainly add in any questions that you have for the panel, and we will be monitoring that so we can address your questions, and we'll be doing that throughout the conversation today. Once again, welcome to our webinar focused on where are hotel asset values today. We'll get started shortly. Panel, I don't know if you could see, we've got Winnipeg, Canada in the house, and we also have Fort Worth, among other locations. So thank you for joining.
Hey, Lori and the Insperity team.
As you're dialing in, you can optimize your view by clicking the gallery view. We highly recommend you use that feature and make sure to maximize your screen and turn up your audio. We will get started shortly. We've got Newport Beach there, Dr. Weiss.
Woohoo!
Your neck of the woods.
Yes.
Thank you for joining, everyone. All right, we are going to get started. We are back and we are ready to have a very energetic, informative, and lively discussion on where our hotel asset values today. And we're thrilled to have our panel back. I believe this is our third time together, and the updates that everybody will share will be, I know, very insightful. I had mentioned this before, but do please maximize your screen. Use the gallery view or side by side. We will be recording this webinar today, and we will be sending this out after the webinar to all. And please do send in questions in the Q&A feature. We will be monitoring that throughout the discussion, and you can also use the chat. We'll be watching both. Thank you so much for joining on behalf of Sales Boost. We're proud to sponsor this discussion today. And Sales Boost is the most advanced skill-based learning platform. In a time that we all need to do more with less, we have solutions that can help hotels scale as you scale. So learn more at info@salesboost.com. We are happy to take you on a demo and support your hotels as they reopen, and again, as you start welcoming customers back. Thank you again to the panelists. We are happy to announce that we've got the gang back together, an esteemed panel. First, I'd like to welcome Glenn Callison, shareholder with Munch and Hart. Hello, Glenn.
Good morning.
Thank you so much for joining once again. We also have Ned DeLorme, and with acquisitions with Jupiter Holdings.
Good morning.
Good morning. Suzanne Millen is back as well. She's our Senior Managing Director and Practice Leader with HVS.
Good morning. Good to see you all.
And Gregory Mount, founder with Victory Hotel Group.
Good morning.
Morning, Greg. Thank you for being with us again. And Mr. Paul Novak, Managing Director with Whitman Peterson.
Good morning, everyone across the country.
Thank you again for being with us. The panel will be moderated by Dr. Donald Weiss, founder of CBRE Hotels and co-founder of Turnbull Capital. Thank you, Dr. Weiss, for bringing us back together again.
Well, we're very excited to have the same cast and crew because we've got some real rock stars here and it's very exciting. Thank you so much, Greta and Andrea, for having us back.
Certainly. And our founder and CEO of Sales Boost, Greta Brooks, is with us. Hello, Greta.
Hi.
And I know you're going to start off with some very important questions. So I'm going to go ahead and turn it over to you to take us away.
Great. So I'll throw out the first pitch or the tennis ball or basketball or football or hockey puck, because I think we're watching all of those at the same time right now. Oh, and race car driving too. So inquiring minds would like to know, there are two differing opinions on the future of our industry. And one is that we are resilient and we'll be back to business as usual once we have a vaccine. And there's another view that will be changed forever and will need to be much more resilient in the future and acknowledge that business must be done differently. So panel, where do you stand on this issue?
Who wants to go first?
I'll take it first.
Great.
I would believe at this point, and I don't think any of us really know yet, is part of the problem. But I would say that it's probably someplace in the middle, probably more towards the side of going back to more normalcy. Probably not getting all the way back there, whether it's 60, 70, or 80% closer to normal is obviously yet to be determined. And I'm not sure anybody really knows. I don't think it'll go the other way, towards, more towards the more negative side or the more technologically oriented side. But I do think that it'll be someplace above the halfway point and hopefully closer to a full recovery, going back to normal. But that's probably not going to happen.
Suzanne, your thoughts on that? Sorry, Don.
No, Suzanne, please.
Sure. Well, I concur with Paul. I think it's a mix of both. I think everybody realizes people like to travel, and the world is global now, and I think there's full confidence in leisure demand coming back. It's just the verdict's out on group and commercial travel and how much that's going to recover. It's going to recover. People need to get together, and but it's just how much, and then what's going to be the industry's response to it. I think how this industry has to remain resilient and nimble, and actually was amazingly so when you think of the shock to the system and how quickly people responded in reducing expenses, even closing down their hotels, doing what they needed to do to conserve cash. And people are going to have to stay on their toes, as they are actually every day when I'm out talking with managers about how they're having to rethink every day what's looking forward, and they're trying to put their budgets together now, and it's very unclear. It's very muddy waters, but there's going to be a recovery. It's just it's unclear to the extent of it, and I think there's going to have to be some reworking of business procedures, and we're going to need some technology to help this industry get fully back on its feet. So I think it's somewhere in the middle, and I concur with Paul on that.
Yeah. Anyone else?
Well, I think as much as we'd all like to go back to just the plain old predictable normal, unfortunately we're stuck with the reoccurring term new normal, and given the scale of the shock to the hospitality industry from the pandemic and just all of the other things that are happening in 2020, I do think there's going to be some changes. And the good news is I think we're in an industry that's well positioned to be adaptable. I've heard this statement, and I think it applies to our industry and the various segments within the hotel business. We may all be in the same storm, but we're not all in the same boat. And I think you can see that, and we'll have that conversation as we talk about, how different types of hotels are recovering differently in this storm.
Yeah, thank you so much. All right, my second question, and because we're technology, I do have to ask this question. So we know that there's great disruption and losses really beyond words can describe for millions of our industry. And yet we're also seeing innovation really shining through the clouds, as it does in normal times. I mean, times like these where we are challenged. How do you see these new technology solutions impacting our industry moving forward?
I think it's been very clear that the internet has really kind of upended, many consumer-facing business models of the past, and COVID has had a profound impact on that as well. And you see some of the recent announcements with, IHG and Marriott, with SVC. You see the Colony sale. You see, in the U.S. you see Accor. You see, Travelodge in the U.K. There's data out there now that is suggesting that independent hotels actually generate a higher absolute RevPAR than branded hotels, albeit I'm sure they're a bit skewed by having more upscale hotels. And so there's many things changing, and I think that we are in a reset. And I think technology, pre-COVID really started to take a hold and was changing the way that consumers were really kind of looking at and booking hotels. And I think that that's going to continue. I think you've seen, the OTAs continue to be pretty prolific during this time, and a large portion of the demand that's being generated out there is coming from, those types of channels, which is interesting. I had a chance recently to look at a portfolio of hotels that we're looking at, and you're seeing more of the demand come through from, these types of channels versus kind of the typical branded channels that you may see. I think that speaks to the ability and the capability of technology. I think, as was mentioned earlier in the last question, owners and operators are going to have to change the way that they do business. This is a generational reset. It's going to require to look at all expenses in a different way. It's going to be important to look at nearshoring and offshoring and consolidation and leveraging technology, to complete tasks that may have been completed on the property in prior lives. So there's no doubt that change has already started. It's going to be, I think, magnified given as we come out of COVID. And I think that you will see, much more of it come and be much more prolific than we've ever seen before.
Thank you, Greg. Does anyone have a differing point of view?
Well, not different. I would just say that technology surprises us all the time. I mean, who knew what Zoom was, 8 months ago or 9 months ago?
Right.
So I would say, the other thing I would say is, buckle your seatbelt. It's going to be a roller coaster.
Well said.
I would agree too with with comments about technology. On the other hand, this industry is a people industry. Mm-hmm. And I don't think any of us in this industry are ever going to lose that. And so I think that while the technology side is going to be a factor, I think there are going to be a lot of people that will not necessarily resist it, but will want to maintain a lot of that personal contact amongst themselves in the property as well as guests of properties.
Absolutely. Well, thank you, panelists. I appreciate that very much. Andrea, back to you.
Yes, thank you so much, Greta. And now we would like to go ahead and say thank you again to Dr. Weiss. When you originally had the idea of having this important discussion, we're thrilled to be able to bring this group together to share the insights, and now we're back, and I know that you've got a lot of questions for the audience. So Dr. Wise, I'm going to ask you to take it away and lead off with your panel discussion, and we look forward to having Q&A for any audience members. feel free to use the Q&A feature. We'll be monitoring that as you'd like to address questions to the panel as well. Dr. Wise.
And if I can say a few words about Dr. Wise, he's the co-founder and senior director of Turnbull Capital Group in Newport Beach, California. And he's a 36-year senior hospitality investment banker. And he was the founder in 1984 of what is today CBRE Hotels during a 20-year stewardship with that firm, and was the founder of what is today the hospitality lending practice at Walker & Dunlop in 2007. And Turnbull Group's 15 senior managing directors have some of the most prominent pedigrees in the hospitality universe, each with his excess of 30 years tenure in shepherding distressed hospitality assets to include new equity and debt placement, hotel ground leases to provide liquidity, hotel and resort asset management, and transactional advisors with an excess of $19.5 billion of borrower and lender executed agreements for workouts, restructurings, and foreclosures in and out of bankruptcy courts. So I met Dr. Donald Wise on LinkedIn. So technology does work well for us. So it's been lovely knowing you through this COVID pandemic time period, and very glad we've made this connection.
Well, thank you very much, Greta, and thank you, Andrea, for teeing things up so beautifully this morning. Good morning, everybody. Good afternoon to some. I wanted to share a mantra today because I read something that I think is very profound, and I wanted to share it with everybody today. If you've not heard Bernard Baumol speak, Mr. Baumol is the chief global economist for the Economic Outlook Group. And he said some very sage words about 2 weeks ago. He said, be very careful about having a false sense of security, talking about the economy on a go-forward basis. And I'll put it in my words, I'll paraphrase a little bit. Don't be afraid, be very afraid. There's still some potholes in the road out there, and we just need to be savvy. As I taught my children a very long time ago, we live in the real world, not Disneyland. Well, let's jump into it. I think Suzanne is up first. Good morning, Suzanne.
Good morning, Don.
Are you in New Jersey today?
I'm in New Jersey today, and I just want to apologize. There was a PIP going on at this hotel unbeknownst to me, so there's some noise outside my door, so it might be noisy when I speak, and I'll mute myself when I'm not. So just want to let you know.
Suzanne and I were teasing earlier. That's what we call the real world.
Right, exactly, exactly.
Suzanne, the pipeline of hotel rooms was aggressive even before the pandemic. Hotel developers had 217,000 new hotel rooms under construction a year ago, September 2020. What does HVS see as the variable and the greatest risk in the appraisal process today, appraising hotels?
Well, first I want to say to your comment about the pipeline, it does amaze me. I mean, there are a lot of projects we think are going to be delayed until the next development cycle, and who knows when that's going to occur. But we are still getting an amazing amount of work for market and feasibility studies for proposed projects. And so hotel developers, hope springs eternal, and there appears to still be some financing out there. So the pipeline will continue, and those that are under construction seem to be opening up. So we still have supplies growing, though it'll slow down certainly for a period of time. And we know that there's so many variables that go into determining a value or what somebody feels comfortable paying for a hotel and what kind of returns they're going to be able to generate for their investors. But when we run through our valuations, to me, the biggest risk is the return of average rate, because I think everybody feels pretty confident that people want to get back to traveling and there's going to be demand of various kinds. But the question is, what kind of demand and how quickly will that average rate recover? You've got two things working on that the leisure travel rate is typically the lowest average rate. And in some of the modeling that we've been doing, once we start, it's typically the lowest rate unless you're at a resort. And some of these resorts have had very high rates this summer because people are getting away. And once you start building back in the group demand that really floats the occupancy of most resorts, the average rate starts to go down actually for a period of time until you recover that group rate. And so there's some risk there. And then for just your traditional hotels, the question becomes, where's that rate going to fall out? Because that rate recovery is going to be driven by demand, and demand creates the compression that creates the boost in ADR. And if we don't have the demand from commercial and group travelers at the appropriate occupancy level, there could be a real gap in ADR, and that could take years to recover. I was just looking back, we're doing some work in my hometown now, San Francisco, and from the dot-com crash, it took some hotels, a select of upper upscale hotels, 12 years to get back from peak to peak. I should say from 9 years from trough to peak, their RevPAR post the dot-com crash. And that was a significant hit to our local economy when the tech industry got shattered. And I'm not saying it's similar to that now, but it's the current shock that we're experiencing is very severe. And it just shows that, you know, everybody's talking about recovery by 23, 24, 25, what have you, but it could take longer for certain markets and certain types of hotels. And there's just a lot of risk associated with the cloudiness of that crystal ball. And I think the ADR is the variable that's got the biggest challenge to it.
Well, back in June, we were predicting that the pundits were saying 2024 for average daily rate, 2023 for occupancy to get back to December 2019. And yet we know that they're saying in Hawaii it could take 6 years. You still think that 2024 overall, I know there's always individual markets, but 2024 for average daily rate recovery is hopefully still pretty close?
That's what we're projecting, and a lot of people are prognosticating, but I have to tell you, the best modeling that everyone is doing cannot really say how it's going to turn out. We really don't know. We're in uncharted territory right now. So let's fingers crossed that it gets recovered by then, if not sooner.
Well, as our host so aptly said back in April, there is no playbook.
Right. That's right.
Good afternoon, Paul.
But Don, I'll add to the comments about supply. I do think that certainly Suzanne has got a good pulse of things out there that are still being pursued from a pipeline perspective. Based on our experience, we're not seeing any debt that is available being any better than 700 to 800 basis points over LIBOR. And that's obviously extremely different than what financing was available pre-COVID, when the rates were someplace in the area of 300 basis points over LIBOR. So you take a 500 point increase to debt for construction loans, and on top of that have a situation where your RevPAR is not going to return till 19 levels until 23 or 24, which may be optimistic, as Suzanne said. It's almost inconceivable that a project can pencil under those terms. Now, obviously, this industry has been fraught with fools. And historically, we've had an unfortunate number of developers who have built stuff that didn't make any economic sense. So certainly there will be some supply, but I think the new supply, once the stuff that's under construction is finished and open, or things that had financing pre-COVID where they had either closed on the loan or had a commitment that the lender couldn't get out of, I think the supply is going to fall very, very significantly.
Well, we used to say in the old days, during the RTC debacle, that the premise was if we build it, they will come, from the film. But you're right. We shall see what we shall see. Paul, according to the survey last week, actually, by the American Hotel and Lodging Association, 67%, listen to that number, 67% of hotel owners reported they will only be able to last an additional 6 months at current projected revenue and occupancy unless there's further government relief. When does Whitman Peterson expect the flow of distressed hotels properties is going to start?
That's a very good question. You know, we sort of would have expected it to start to flow a bit by now. But I think that the PPP money and the lenders being willing to forego interest and debt payments and accrue them towards the back end for the first 90 days of the pandemic obviously has slowed down that situation of stuff finally just hemorrhaging and being either turned back to the lender with the keys or the lender foreclosing. So I think if there's not some additional help, which I'm not sure how much of that's actually going to go to the hotel industry, I think we're going to start to see properties really starting to flow towards the end of the year, the first quarter of 2020. People just are not going to be able to hang on unless they've got extremely deep pockets and are willing to continue to pour more capital into assets. Strong investors like ourselves, we can do it. We will weather this storm, and we will own all of our hotels when this is over. But there's a lot of people who just simply don't have that financial wherewithal. I think the other thing that's very interesting, I've been, and I don't know about anybody else on the panel, but I get flyers on virtually every single asset that comes to market right now from virtually every hotel broker, non-hotel broker in the country. And I have been amazed at the number of properties that have been coming to market where the guidance is basically the same value of the asset at the end of 19. And it just boggles my mind that there are people out there that would actually believe that they can make an economic transaction based upon a value at the end of 19 and have to carry that asset until it recovers, whether it's 22, 23, 24. I've been astounded by that as to the number of people that really think they can sell their hotels at fundamentally full market value.
Well, it sounds like we still have a little bit of denial out there.
Perhaps a lot.
Wishful thinking.
Good
And
morning,
I'll just
Greg.
jump in on, just what Paul was saying, that, the fact that, you have forbearance 1.0, forbearance 2.0, and the PPP stuff all starting to run out. There's going to be, I think a number of hotels that are going to be in distress very soon.
Well, that segues into our next question. I was reading about a bankruptcy jurist that was opining about the hotel business, saying that the two hotels that they're seeing in bankruptcy or receivership are pretty much what everyone on this panel would have suspected. Number one, they were in trouble pre-COVID, which is kind of what we've been saying in our firm from the get-go, that any hotel that had not stabilized pre-COVID was going to be very, very high probability of having to turn the keys back. And the second by this jurist, this bankruptcy jurist, was it's just cases where the borrowers have just given up. They've just said, stick the fork in me, I'm done. So the question for you, Greg, if you could, to an owner who's in this kind of situation, or that maybe they're in denial still, and they've got to face reality, do they sell now or do they wait?
That's a great question, and I think that the first question I would kind of have as an owner is and I think they have to be realistic. I mean, can you sustain a 45 to 65, 60% occupancy with a 20 to 30% rate drop for the next 18, 24 months? I'm not so sure. I think that there are some hotels, and we've seen some data that says that they can break even at about a 45% occupancy. But I think an owner has to be realistic when they're kind of looking at their future. You know, there are so many variables that come into play with this, and some of these decisions may be taken right out of the owner's hands, as you know, everyone has just been talking about. And I think from what we're seeing, you know, as we're looking at the deals that are coming through, particularly, you know, the ones from the lenders, you know, these deals are trading at about 80-90% of par. And, you know, that means, you know, zero for the owner. So I think an owner has to be realistic at this and look at their situation now and make a decision. I don't think waiting is going to help. You know, if you look at a large majority of the equity that's sitting on the sidelines, and there is, they're not so sure we've hit the bottom yet. And so I think as an owner, now is the time to start taking steps to maybe look at a preferred equity, look at a joint venture, you know, look at some type of structured hope note, you know, look at you know, a deed in lieu, things that can, you know, that you can negotiate and look to, you know, fight another day, or at least get some value out of your asset. Because if you're not able to sustain in those lower occupancies and ADRs, the decision is going to be made for you. And I think that now is the time for owners that may have some value, that are in those locations, to take steps to have those conversations. And I think there's willing equity on the side right now, to you know, bring in from a preferred equity standpoint, to joint venture, you know, to look to be a partner, to get through the next, you know, 18, 24, 36 months, to help restabilize. Obviously, the owner will have to give up some, you know, some of their equity to do that. But that may be a better decision at this point.
Well, you actually nailed it, because we talked about, I think it was Paul's comment on our previous webinar. We were talking about the fact this was 99 days ago. You know, was it too early to squeeze the trigger, quote unquote? And you just nailed that one as well. The other issue is that many markets, I won't name names because that's not nice, but many markets are still perceived as a falling knife. Mm-hmm. You're absolutely right. We just don't in our heart of hearts believe we're at the bottom yet. Ned, let's go back a little bit to a couple of points that Greta hit on earlier. There's growing optimism about business travel and convention travel. 37% of the respondents to the Global Business Travel Association survey last week indicated that they hope that they will have meetings again by the first quarter of 2021. 61% by the second quarter of 2021. Any thoughts from your perspective on, you know, that tracks, or if it's going to take longer, based on the real world that we all know?
Yeah, I think that there's the problem right now is just the mass psychology is still fairly negative. There's a lot of light at the end of the tunnel, but there's still too much. I think fear is the global word in the markets. But people do want to travel. People are probably at this point sick and tired of Zoom, and they're missing their conference where they can go and efficiently meet 200 or 300 people. And there's no spontaneity at all to the technology. It's pretty cut and dried. And I guess if you're, you know, if you're that kind of data geek, then maybe it works for you. But I think for the most part, people who are out doing business, doing deals, selling, meeting people, whatever it is their business is, they need to meet people. And I think it's going to come back. I mean, I'm still short-term pessimistic, certainly about hotel values, but I'm long-term optimistic because I do think it comes back. And I believe it'll come back, it'll snap back. I think it'll be a combination of getting past the political season. I think once we have the availability, at least, of mass vaccinations, I think that'll change the psychology. Whether it works or not is irrelevant, because it's all about changing the mindset. We're looking at a project that has a gaming aspect to it. I was looking at some numbers for Las Vegas yesterday, which is pretty interesting because as you know, Vegas is primarily driven by drive-to traffic from Southern California, and year over year, the car count at the border, Nevada, California, is only down about 9% year over year in July, which I find kind of interesting. And ADR was also down, obviously, but not as much as I thought it would be. It was down about 18%, still showing at least a strip ADR for 2020 of 100 and almost 116 July, $116 versus 136 last year. So it's proving the point that people still want to go. They still want to. They need a diversion. They want to have fun. They want to meet other people. So I think that's going to happen, and I do think it will snap back faster. I agree with Paul and Greg. There's going to be a lot of short-term pain for owners, particularly owners who are undercapitalized and who are leveraged. Many of which, as you pointed out, Don, were over-leveraged and undercapitalized going into this thing. So this is just going to precipitate and accelerate the liquidation of a lot of assets. I mean, there's always 10 or 15% of the market that's kind of teetering anyway, but now that's just been pushed over. And I certainly believe the statistic that probably 40% of the hotels don't make it. And if you've got non-recourse debt with a CMBS lender, you probably, unless you're very low leverage, you're probably just going to give it back. So I do think you are going to see a lot of liquidations over the next 6 to 9 months, which will, in the short term create a lot of uncertainty, but I think in the long term, it'll revalue the business as a whole, and I think it'll get rational again because, Suzanne pointed out there's a lot of stuff that got built that just wasn't economic, and it's going to end in pain, end in tears. So that's my story.
And you're sticking to it.
And I am sticking to it.
The term was the hotel industry is under demolished, but just FYI.
Correct. Yeah, and we've been that way for years.
It has been absolutely.
Yeah, so this is going to accelerate that process. It'll be great for guys with capital. I mean, we've been looking for deals. We've been looking for and bidding on non-performing loans. We're certainly willing to look at a rescue capital pref equity situation if it's large enough and it meets the criteria. The problem right now is just visibility on cash flow, visibility on occupancy and rate. Nobody really has a good crystal ball because you just don't know. I do think it's going to be, I think a year from now, we're going to look back and say, wow, glad that was over. But, I think we'll be back to some level. But I think going into this thing, at the end of 2019, I mean, almost every deal that I looked at, I thought was overvalued by, 20% at least. So it's going to make for more interesting, a bigger opportunity set for us to look at, what we perceive anyway as a value investor to be really good buys.
Well, to your comment earlier, I typically, before COVID, I had 3 meetings a day with clients. I use the Fashion Island Hotel as my office, de facto office. I can tell you that post-COVID.
I know, I bought you lunch there about a half dozen times.
I know you have. but the point of the story is, post-COVID, I've had 4 meetings. 2 of them were interviews with new partners, and 2 were business clients.
Yeah.
And I've had to cancel 2 meetings because I actually had anxiety attacks. Just the idea of going someplace and being around human beings, I literally had an anxiety attack and canceled a meeting. So you can see how quickly all of us have had to internally and externally change through this incredible period of time we've been through. Glenn, good afternoon. I think it's your time.
Good afternoon, Don.
Interesting story I just read, and I shared it with you yesterday. A Securities Exchange Commission whistleblower complaint was filed in May, alleging that financial institutions such as Wells Fargo and Deutsche Bank have been systematically and fraudulently inflating the value of properties in CMBS loan packages. Behavior strikingly familiar to what precipitated the subprime mortgage crisis in 2008. Is this deja vu all over again, Glenn?
So it's an interesting question. The whistleblower, John Flynn, filed this suit, as you said, basically saying that these banks had, artificially inflated valuations in order to, allow for larger LTVs and more loan proceeds. So, you kind of look back to, the financial crisis of 2008. you know, that was, you know, the issue, although it was primarily centered around, you know, home mortgages. And, you know, and it ultimately brought down, you know, some large banks such as Bear Stearns and Lehman Brothers, who both filed for bankruptcy. But perhaps different in this time, you know, while that was the crisis in 2008, we've got a pandemic as the crisis today. And so, you know, the fact that this type of behavior was happening pre-pandemic, where, you know, valuations might have been artificially inflated, perhaps juicing up the market more than it would have been otherwise, I think it's a big concern. You know, the Federal Reserve pointed out why this matters to us in their 2020 May 2020 financial stability report. They basically said, you know, prices of commercial properties were highly elevated relative to their income streams on the eve of the pandemic, suggesting that their prices could fall notably. So anyone who's out there thinking that they're just going to go in and perhaps buy, you know, large portfolios for the debt price needs to, you know, maybe evaluate, you know, how those portfolios were valued at the time that the debt was put on to make sure that that was an accurate valuation.
Well, no, you absolutely nailed that one, Glenn, because there's two issues involved. Number one, is the debt really worth par? And number two, you have to put in a second in-depth evaluation on the bankruptcy risk. Because in some cases, you may want to, if you get that hotel back, you may want to keep it closed for 1 or 2 years. So these are all, you know, these are all very, very thorny issues. And speaking of challenging and thorny issues, Suzanne, you're the master of the universe on that subject, so let's throw you another one. U.S. hotel industry occupancy was 48.6 in August, according to Smith Travel Research. Tripp says the percentage of hotel loans that are 30 days or more delinquent was 23.4% in July, up from 1.34% at the end of 2019. How elevated has HPS seen discount rates and cap rates change in asset value underwriting since COVID?
Yeah. Well, building on the prior comments by the other panelists, I think there's an optimism that's going on with all the capital that's lined up to pursue some of these assets that have been brought to market, that may, over time, the return to their investors may just not pan out, because I think people are looking to buy at a discount to pre-COVID values. And just as what Glenn was saying, the question is how overvalued were those pre-COVID values? I mean, hotels were riding on a razor thin increases in net income. In fact, many hotels were already sliding, their net income levels were sliding. And I think the pre-COVID valuations were very aggressive. And, you know, of course, as an appraiser, I'm always a little sensitive to this because we're charged with the task of reflecting the market. We are never asked, well, what do you really think it's worth? We're supposed to reflect what the market thinks it's worth. So just in our own defense, there are times when we value hotels and people are paying, you know, the markets, there are multiple bids at a certain level and we're all shaking our heads, but that's what we have to conclude to as market value. And that was going on pre-COVID. And so now we're seeing people step in, multiple bids, bidding up the price of an asset. And well, we're thinking the value to pre-COVID should be down 35%. The bids are coming in down 20 to 25%. And they're built on a lot of, you know, assumed recovery that may or may not come to pass. And the discount rates that we're seeing, you know, when we look back at what happened in the Great Recession, and discount rates did rise, I just looked it back up, about 75 to 180 basis points over the discount rates pre-Great Recession. And right now we're barely seeing an uptick. This is based on survey data, just a slight uptick in discount rates. And if we actually elevate discount rates and terminal cap rates in our DCFs too aggressively, taking consideration you know, the lack of debt, the higher interest rates, all the risk, if we factored that all in, we wouldn't be hitting what the market is paying for assets right now. So we are using somewhat elevated discount rates in our valuations, but I don't think anywhere near what would be required to reflect the risk that investors are facing when they're buying these assets. So, you know, only time will tell. People who invest in hotels have to be not particularly risk adverse just to be in the hotel industry. So you have to have a pretty, be optimistic just to be, confident in that you're going to be able to generate, value when you buy an asset. So only time will tell, but we were seeing somewhat of an elevation of discount rates, but not as much as you might think in a discounted cash flow analysis right now.
I've had Suzanne working closely with my partner in crime, Michael Brannigan, and exactly what Suzanne has said. The trying to anticipate operational shortfalls on a go-forward basis, and how do you fund those? Funds have a different way of doing things than an individual investor would have, but the IRRs, if you fund all of those operational shortfalls in advance, those IRRs get very, very soft, very, very fast.
Yeah.
We've seen exactly 100% everything that Suzanne just said. Paul, we hit on this a little bit earlier. We've talked about Zoom meetings from the comfort of our homes and so forth. So there's got to be some paradigm shifts here. In your opinion, what are those paradigm shifts going to have to be so that people will get back-to-back and get comfortable with back-to-back meetings with human beings and being out in public and being with their friends and colleagues at conferences and hotel events and so forth? What's going to have to happen?
Well, clearly a vaccine, and widely distributed vaccine is probably the only thing that's going to give people real comfort to come back in large numbers. And a vaccine that actually is working, and the virus starts to dramatically drop off, so that you're not at much risk. And that's probably going to happen. Whether it happens this year or first or second quarter of next year is still hard to tell, because there are so many people that will need to be vaccinated. But I think once that does happen, and I know myself, a lot of people I talk to, as somebody said, I remember if it was Ned or Greg, just fed up with Zoom meetings. I mean, I've gotten out a couple of times where I've driven on a couple of business efforts. Suzanne's flying today and yesterday. People are just, climbing the walls in front of the screen. And I think there may be actually a huge surge of people wanting to get back to interacting with people simply because they've been isolated in their office in front of the screen now. It's now 6 months, and it's going to be probably another 6 months before there can be a fair amount of people that are willing to get out. It's interesting, the statistic you stated about people thinking that they'll go to a convention, 37%, I think you said, in the first quarter. And that's a bit shocking to me, that people really think that it's going to be that safe, or people are going to think it's safe to go first quarter. I think by second quarter, and I think Alice, for our industry, is going to be an incredible indicator as to whether or not that conference actually occurs and what the attendance will be. But my bet is it may not be the 3,000 they've had historically, but I wouldn't be surprised if it isn't at least 2,000. I think people want to get back out, interact with people, network, maybe never shake hands, but at least bump elbows.
Well, you're absolutely right. That possibly could happen. I mean, I'm sure you remember back the stories about what they called a revenge retail. When Hong Kong opened back up, people were literally lined up to go into the Cartiers and the Gucci's and so forth to shop. Maybe we'll see the same thing with people just wanting to get out of the house and travel and get on airplanes and so forth and so on. Clearly a wild card, and as Greta said in our very first webinar, there's no playbook here, so we're all just guessing. Greg, we know that we're going to come through this. We're human beings, we're resilient, we're optimists, we're going to get through this. some of the biggest shifts in the market come with major downturns such as this. What will create the opportunity for success for hotel owners post-COVID?
And, I think that really, organizations and, operators and brands and everyone needs to start thinking about this right now, right? Because, the companies that can protect people and build the best experience with real agility will create competitive advantage and truly accelerate faster out of this downturn. Post-COVID companies, I think will be evaluated and defined, quite honestly, by their capability to balance performance, their capacity for flexibility, as well as their short-term forecasting will become very, very important. Those that will have an advantage, when they can manage what they encounter. That's an old saying, but a very important one. And things are changing on a monthly basis. And I think that companies have to be flexible and they have to be able to manage what they encounter, not what they necessarily expect. And then lastly, I think it's going to come through confidence. That confidence will come through innovation. Greta had a question early on as we started this panel that I think is correct. And I think that those that look at innovation and then kind of bring that into the experience and then are able to replicate it are going to succeed. And then lastly, it's all about leadership. When you boil it all down, it comes to the leadership in these companies. And I think there's a real opportunity right now for organizations to reset and evaluate their leadership at all levels and make sure that they have those leaders that are going to be able to have the comfort, the confidence, and be comfortable in their own skin and be willing to innovate and manage what they encounter. It will help them, as they emerge out of this.
Excellent points. We hit earlier on, was brought up perhaps the shift to independence. Ned, major brands have suffered massive layoffs.
That
layoffs
too.
and other. Can the brands continue to grow and with more operators considering to become independent? We talked about this a little bit earlier.
Yeah, I don't know how the brands continue to grow, Don. I mean, they've got, they used to have teams of franchise salespeople out beating the bushes, which is why you have a Marriott on 4 corners of some major intersection, if not 6. But I just don't see how that's going to continue to grow. We've discussed how difficult and expensive financing is. Construction financing is really difficult unless you've got a really unique location. So I don't know how they grow. I look at their valuations as asset light, taking money off the top and taking in, licensing fees. And I just don't know how that, I don't get the valuations of those kind of, I could be completely wrong. I've been wrong about everything, including Tesla. So I don't know, but it doesn't make sense to me from a fundamental basis why they could grow. I mean, we certainly don't need any more hotels. Will independents join a brand for more visibility? I don't know. I think Greg made a great point about the OTAs being a lot more savvy than brand.com in a lot of cases. And I think, given that a hotel room to a certain extent is still a commodity, the average traveler is going to pull their phone out and go to Hotel Tonight or whatever it is that they use, or 3 or 4 apps and try and find a deal. So I don't know that the brands can really continue to grow. I'm not terribly optimistic about that. I think you probably see more independents. And they're the value proposition for the OTA is still pretty expensive. I mean, anywhere from 15 to 20+% off the top is a lot of money to pay. When you could probably with good technology do your own website and ally with a lot of these other all these other channels. There's so many out there now. It's amazing. So,
well, you're on a roll. Real quick, what do you think is going to happen to resort fees?
Oh yeah, we talked about that a little bit. I think if you've got it's people are going to want to travel. They're going to want to go and get away. I mean, I know a lot of people who have just basically disappeared to you know, Cancun or somewhere for 3 or 4 weeks because they got a hell of a deal. I mean, right now, obviously, you're not going to get a resort fee out of somebody necessarily, and most people who know always push back on them if you're in the business. But you know, it's about the value proposition. If you've got a you know, if you're offering, you know, Wi-Fi and spa access and a great fitness club and, you know, airport shuttles and all of those sort of things, then you may be able to justify it. But I don't, you know, I think the low-hanging fruit of free money from the resort fee is pretty tenuous. Because it's really a function of demand, right? If you've got a lot of demand, you can charge the resort fee. If you don't have demand, you're not going to be able to do it. So,
you know, Dr. Wise, if I could add something to the earlier question, which I think might be relevant, and I saw the statistic and I was quite amazed by it, but you know, branded hotel penetration has really stalled in the U.S. It's only risen about 200 basis points in the last decade.
wow.
And if you think about that with all the various brand launches and the varying degrees of success of that, I think that's an interesting statistic when you really look at it at the heart of what's actually occurring from an overall penetration standpoint.
Well, no, you're absolutely right. I mean, I'm dealing with a very prominent high net worth right now, and they have almost 30 hotels, and they run them totally independent. And I asked why. They said because of the internet. So again, this goes back to technology. They can get this from their perspective, one brand's opinion, one owner's opinion, to get as much bang for the buck, you know, using the internet, whether it's Groupons or pick a subject. So it's, again, technology is definitely a sub theme here. Glenn, I want to have you hit one more, and I thought maybe we'd open up to Greta perhaps to respond to some of the folks that have been asking questions. Glenn, Colony Capital, Mr. Tom Barrack had a $3.2 billion problem, pretty amazing, has entered into a definitive agreement to sell his 6 hospitality portfolios to Mahmood Khimji, Highgate Holdings, a transaction valued at $2.8 billion. 6 portfolios represent 22,676 guest rooms and 197 hotel properties. Is this a sign that the tsunami has finally hit the beach?
Don, I think it very well may be. You know, it's interesting. Colony had a total of 7 hotel portfolios, and probably the only reason that 7 weren't part of this deal is because they had already given up one, and it was in receivership. So it had 48 hotels, and those have all already moved into receivership. So when you look at the structure of the remaining 6, I mean, Colony's basically saying that they're exiting the hotel business, and they did so. You know, what looks like a big number, 2.8 billion, but 2.7 billion of that was a debt that was being assumed. So there's you know, virtually no equity at all, you know, left in the portfolio. And so, you know, if you have to wonder if Colony is doing that, if there's, you know, others that are not far behind and willing to go that way. You know, it's interesting, you know, one of the participants put a question out there, you know, asking, you know, are we seeing, you know, lenders, you know, balance sheet lenders in particular that are ready to, you know, start moving towards foreclosure to take over assets? And, you know, the answer is we have not seen that, but we're seeing these receiverships, much like in the Colony case, where lenders will come in and take control of the assets without taking ownership. And really the reason why is, you know, the lenders are cautious because they know that they're going to have to feed these things. There's probably deferred maintenance issues out there. And before they step into the ownership through foreclosure or deed in lieu of foreclosure, they want to see exactly what's going on, and they can use the receivership function to do so.
Excellent overview. Well, Greta, you want to see what's going on as far as some questions from our viewers out there?
Mute. So we have had quite a few requests for information related to the presidential debate. I'll let you guys answer those questions after post the event. So any questions that you do send to us today, the panelists will respond to your questions, so send them all. But we did get one that does correlate back to the brand discussion a bit, and that is, are we seeing, and Bill Scanlon asked this question, do we see owners challenging the brand fees with support services? Are we seeing a movement there?
Greg, that might be a good one for you.
Sorry, it just cut out on me. Can you restate that, Greta? I apologize.
Yeah, are owners challenging the brand fees due to the lack of services, support services?
Yeah, it's a really interesting discussion. I don't know that owners are in a position to really, challenge that at this point. I think that it's really going to come down to more of the brands being able to react and understand what they need to do to help these owners survive. And I think that they have to partner with these owners to be able to do that. I mean, the take rate from brands right now is averaging about 13%. So it's not, inexpensive by any means. And when you start to compare that to, the other options that are out there, we had a great discussion about, the independent hotels and the fact that they are starting to really begin to compete on a much lower cost basis, particularly as technology becomes more prevalent. I also think that the OTAs have a real opportunity right now to go in, particularly as the brands, and you're seeing this very clearly, are struggling because their loyalty members are not driving, the demand that they had in the past. The demand is coming through leisure travelers, which the OTAs tend to own a large majority of. And so I think it'll be very interesting dynamic. I think that the brands are going to have to really take a look at this and understand it. And work with these owners, or I think you will see owners start to depart and move to platforms that are going to reduce their costs of getting demand into their hotels.
Just a quick observation. What we're seeing is that the brands, while they're being responsive to owners' requests, they're not waiving anything. They're simply forbearing, much like the lenders.
Mm-hmm.
And I think we have to keep in mind, in defense of the brands, if RevPARs have dropped 40 or 50 or 60%, their royalty stream, their fee stream has dropped 50 or 60%. So the reality is they haven't got a lot of room to give up much more. And the other reality is that even if you've got, once you're down that low, even if you've got a 10% reduction in your fees, it hardly translates to very many dollars. So I think that the brands are in a very difficult situation. I think the other issue is, contrary to what Greg has said, certainly properties and owners are going to want to look at maybe alternatives in getting out of the brands. But keep in mind that all the major brands have significant penalties to buy your way out, often in the millions and millions of dollars. So it isn't going to be that easy for somebody just to say, I'm tired of it, you're not being fair to me, I need help, and you're not giving me help, and I'm going to leave. And those payments to buy your way out at this point are all going to be based on 19 numbers. So if you're going to do it, you probably have to do it 2 or 3 years from now, when your average royalties, which is what it's based on, are dramatically lower.
I've always said on our past calls that, I'm a big proponent of the brands. And as we're looking at acquisitions, we obviously want to be brands. Brands have proven to return more quickly and have provided some safeguards through downturns like this. So I don't want to confuse the message, but I think the reality is there. And I think there's also, and Glenn can obviously comment on this much better than I can, there's a thing called force majeure. And I think that as this gets deeper and gets to be more critical for owners, I think that you may see people look to make some changes. But it's just a guess at this point.
Well, thank you, Bill Scanlon, for a great question. Greta, you want I throw another one out?
All right, one more. We've got a lot of questions. We have 18, 19. Well, we have quite a few. So is it time, Karen Kapoor, hopefully I said that correctly. Is it time to do a complete overhaul of how we follow and analyze performance metrics? Do all the panelists and eminent speakers here believe that it's time as we in an industry start looking at TrevPAR or maybe TrevPOR instead of RevPAR?
Well, that sounds like that's got Greta's name all over it.
I guess that's a is that technology?
Well, it's also, that's in your space.
Well, I think the metrics here are that you're going to have to, I mean, it's profitability. It's always going to be profitability. So your metrics are going to have to be different. But I think, you know, as we look at forecasting, or if we look back at history, that's going to be the most challenging part of all of this. And so we don't have a crystal ball anymore. And we really don't have history. This past year will be, you can't write it off. It is part of our history. So it's going to be very challenging. But metrics, I think when you're dealing with capital, you need to determine how you're going to utilize that capital. So I think the human capital component, as we go back to the very beginning of this, is, you know, 80% of our budgets are dependent on human capital. And so we have to make sure that we are really good stewards and we take care of our team members in a way that we can maximize the output and the revenue contribution and the profitability of our properties. And so that should be top of mind. But yes, I think we should have new metrics. So that was a great question, Karen. Thank you.
I think it's important to think about, though, that, you know, in the hospitality industry, we're kind of fortunate as compared to other real estate classes that we have access to kind of real-time data,
right,
you know, immediately. But we're also very much subject to, you know, dramatic market shifts, you know, that other real estate classes aren't, because, you know, our revenue stream can reset nightly.
Yeah, and if you have the right technology, you can see exactly what's happening to your, you know, your revenue management, you know, whether those strategies are working or not, you can pivot. So taking on perhaps more of a different industry like software, where you're nimble and you're really pivoting quickly, evaluation, analysis, and data is going to be really important to make sure you have good data and you have good systems and a good way to track this and make good decisions. So get smart people in the room with great technology and great systems, and you will do well.
Anybody else?
Yeah, I mean, obviously, it's a total revenue per occupied room. It's if you get a select service hotel, it's pretty much a meaningless number. But if you've got a full service facility with multiple revenue departments, then yeah, you want to look at, you know, what people are spending in the restaurant and what they're spending at the bar and the gift shop and all the spa and all those things. But, you know, for the vast majority of properties that are select service, it's a very simple operating model. So I just wanted to, apropos my prior conversation, everybody should subscribe to Brian Westbury at First Trust in Chicago. Publishes, I think, every week a COVID tracker. And you can get it at FT Portfolios, franktomportfolios.com. And it's pretty interesting. And he uses statistics from the vaunted CDC, whatever that means. And you look at these numbers and you say, why isn't everybody traveling? So if you're 50 to 69 years old, the infection fatality rate, this is as of September 10th, and this is coming from, again, the CDC, if you believe them. So it's 0.5%. If you're 20 to 49 years old, the infection fatality rate is 0.02%. And if you're 0 to 19, it's 0.003. Now, if you're 70 plus years old, and I actually thought this was pretty low, 70 plus years old, and you get it, there's a 5.4% fatality rate, which is, you know, 5.4. So you have about a 96% chance of surviving. Not bad. So the fear is, at least statistically, unwarranted, and I wish people would get back to travel.
I think they have to let people know what happens when you get it now and what the new medicine is and how they're dealing with people that get it, because it's not just dying. Like, I'm scared to death of just having my lungs destroyed for the rest of my life. But
sure,
yeah, it seems to be that they've come up with things that have to ameliorate those things. And like, I think there needs to be, you know, of course, if we could everyone could trust the information coming out, it would be helpful, but.
Yeah.
But I agree.
You're not getting accurate information from the mainstream media. They're more interested in fear, and it's, you know,
Well, also
political,
but the CDC is all over.
they're doing a terrible job. I mean, these numbers should be broadcast every day. You got a 0.5% chance of dying if you're between 50 and 69. Who knows that? Nobody knows that. So anyway, subscribe to Brian's newsletter. He's great. He's on you know, CNBC and CNN and Fox and everywhere else. And he's a very good economist, and he does good work. So
Great, thank you.
Great. Greta, we have time for one more.
All right. This is going back to the spending money. So what do you see regarding refreshes or PIP renovations due to lower occupancies? And Suzanne, you're in one right now, so apparently they're performing some of that.
Yes, and this one sure needs it, I have to say. But just in my travels the last few days, there are a lot of hotels that have not undergone necessary upgrades. And this would be a good time to do, but whether they have the money to do it is another question. Whether they can be forced to do it by the brands, I don't know. But it would be an excellent time to do it when you're running, you know, whatever, 20% occupancy. So,
You know, one quick observation, based on some workouts that we're, you know, currently, you know, negotiating, a lot of the FF&E reserves that are out there for upgrades and PIPs are being used to pay debt service and other current operating costs. So it's highly likely that we're going to, you know, come through this in a few months, and there's, you know, those FF&E reserves are going to be drained, and there's not going to be a lot of money out there to do the upgrades and PIPs.
yeah.
Well, that is one of the places where preferred equity can save the day. But I know I'll let Paul speak because I know he has a review on that.
Yeah, I mean, there is undoubtedly over the next 24 months going to be a need for capital infusion into the assets themselves physically, because there, you know, maintenance has been cut back. You only spend money on things that you absolutely have to do. And it has the potential of having a snowball effect on the physical condition of the asset. And the only place that you probably are going to be able to draw that money, because you're not going to be able to refinance likely based on your trailing 12 numbers. Once we get out to a trailing 12 in March of next year, it's going to have to be preferred equity or preferred capital that's coming in.
Well, we had suggested actually on our very first webinar that for those that are well capitalized, that do have, whether they're family office owned or whatever the sponsorship business model is, that, you know, three things would be accomplished. You have a better chance of kind of taking a page out of what Bob Alter did with the Sunstone business model. Get your occupancy back faster, hopefully maintain your ADR, grow your ADR faster. And lastly, perhaps as important as all the other two, is cannibalize market share in your individual market, because you have a nicer box. It's kind of like the new restaurant that everyone wants to go to. A nicer box that's cleaner, prettier, etc. And that can save the day as well. Do we have time, Greta? Or are we about out of time here?
Well, we can go around and see what advice each one of you has for the hotel community right now and last words. So we'll go around and start with Greg. I'm going to do the Brady Bunch version. So I'll go to Greg.
Yeah, look, I think that you know, that now is the time to really kind of self-evaluate and look at your assets and understand where your competitive advantages are. To look at the people that you have that are running your assets and your leadership, and understanding, you know, that those are the people that are going to have to execute your strategies and tactics to help you exit from this. And I think you need to make sure that those people are innovative, they're dedicated, they're flexible and nimble, and willing to look at doing things differently, because regardless of whether you feel we're going to get back to where we were, you can't go through this without expecting that changes have occurred and things are going to have to be done differently. And so you can't go back and assume that you're going to do the same thing that you've always done. Things are changing and they're changing quickly. So be fluid, be innovative, and be able to replicate.
Scale. Yes.
Yes.
Scaling.
Yep.
Ed.
Unmute. Well, look, we're fortunate. We don't have any legacy assets, so we are exceedingly lucky. So my advice would be, don't own any hotels prior to going into COVID. If you get back in a time machine. Yeah, I mean, Greg is right. You've got to really evaluate what you have, where you think you can go, and what's reasonable, and decide what you're going to do. I think a lot of people are going to walk away. A lot of people are just going to reevaluate what they have. I think a lot of people are going to do what Colony did, which was basically just offload properties. It's going to be tough for the next year if you're an owner. So.
Thank you. Suzanne, sorry.
Sure, no problem. I guess I would say for all the equity and all the investors that are lined up to enter, looking for an opportunity to purchase below pre-COVID values and what have you, that they need to look hard and fast at what they can really feel confident doing with an asset, and make sure they have adequate reserves to weather the storm, and potentially don't overreach, because we're seeing now people competing for assets and driving up prices, and here we're stepping into a completely unknown environment going forward, and people are looking so closely at, there are a number of firms, including ourselves, that do forecasts out for the next 5 years on occupancy, ADR, and RevPAR recovery, and I can tell you, those are all based on models, and what's being prognosticated might just not come to pass. So you have to make sure that you factor in a good cushion, and sometimes it's better to walk away from a deal if it's getting bid up too much. So that's the advice I'd provide.
Thank you. Paul.
Hard to add much after all of those. I think, certainly what Suzanne is saying is very, very critical. It's going to be easy to be attracted to something because it looks good, and yet it really doesn't have the staying power to get through this pandemic, which is for the industry will last a few more years. I think the only other advice is, to the extent that you can find some additional capital, one way or another, to try to shore yourself up over the next 12 months. That's probably a very, very good use of your time, in addition to all the things that everyone else has mentioned.
Thank you, Paul. And Glenn.
Okay, sounds like the last word. Two thoughts. One, with respect to owners looking to stay in their assets, they just need to make sure they're communicating regularly, particularly with lenders and the brands as well, making sure that they're documenting whatever agreements that are out there so that they have a clear understanding of what the path forward is. And then most importantly, understanding what the non-recourse carve-out provisions might say in their loan documents. So for those parties that have non-recourse debt, they don't want to trip up those non-recourse provisions and all of a sudden find that they have guaranteed something beyond the outstanding debt. With respect to those that are looking to acquire assets, again, I think both Paul and Suzanne mentioned being careful about that process, but perhaps the best place to look is to track the distressed debt and be talking to those lenders that may be taking those assets back. And before they do that, looking at an opportunity to buy the debt that might give them the best option to buy into a property at the right price while still protecting themselves from downside risk.
Very sage advice. And last but not least, Dr. Wise.
Well, listening to Suzanne reminds me of one of my oldest friends in the hotel industry who was with the brands for many, many years. And he had a wonderful quote. He said, the hotel industry is like a screen door. All the flies on the inside want out, and all the flies on the outside want in. talking about some of that new capital that wants to get in the hotel business because of our interesting time we're going through. I would say two things in closing. One, let's go back to our mantra. Be very careful about having a false sense of security. You know, we're ramping up, things are improving, but there's still minefields out there. We have to be careful. Let's not, what was your friend, Mr. Greenspan, over exuberance. We need to caution. We want to see the light at the end of the tunnel. It's going to come. We just have to be very, very savvy getting there. I'll close once again with what I had the pleasure of telling Peter Jennings back in 1991, and that was the key to the hotel business is putting heads in the beds, and what we have to do to put those heads in the beds. So with that, Greta, Andrea, the whole team, our entire wonderful cast and crew, thank you, thank you, thank you, and we look forward to seeing hopefully everybody again in about 90 days, plus or minus.
Great, thank you.
Great.
Thanks so much.
Thank you to our terrific panel. It was such a lively discussion, and the question remains, where are hotel asset values today? Your advice and your insights were extremely valuable to all. So thank you on behalf of us and behalf of the audience to the panel. Dr. Wise, I think we should get the gang back together again, maybe in the next month or so.
We'll see.
We'll see. We will be sending the webinar recording out tomorrow, that's October 1st, to everyone who has registered. And again, if you are looking for the theme from today, what we heard was, hotels need to take care of their human capital and have technology innovation to help with the hotel asset values. So that's one thing that was constant, and we appreciate everybody. Greta, thank you so much for hosting. On behalf of Sales Boost, we wish everyone a lovely day.
Great. Bye-bye.
Thank you, everyone.
Thanks so much.
Bye.
Thank you.
Bye-bye.